So if you just look at finance in general, a lot of finance is about figuring out the value of things. How much is something is worth? Because that drives pretty much all the decisions we make. How much is a potential business worth? If we buy a stock in Apple, how much do we think the Apple stock is worth? What's the risk of buying a new piece of equipment or starting up a website? What are the potential returns? Because all these things play into whether or not we want to do them and invest our time and money in them. And that all comes down to figuring out what the opportunity is and what the value is. And even if we take out a loan or we find equity investors, what are the difference between those and how much will they each cost us? And so that all comes into play when we look at the risk and the cost or returns of things in terms of figuring out what our best options are. And usually those best options come down to figuring out what they're worth. And that's really much drives everything we do in finance. And then if you look at how we study finance, and this is kind of how our finance concentration is organized as well, corporate finance is looking at it from the perspective of a company and how a company makes financial decisions, whereas investments is looking at it from the standpoint of someone who has money and they have an investment portfolio where they want to invest or buy different types of financial assets or securities, stocks, bonds, mutual funds. We'll talk about those more. So that's kind of how finance is usually broken into two parts: corporate finance and investments. Okay, and this course is kind of like the first half of corporate finance. If you become a finance concentration major, you'll have a second course in corporate finance where we'll go into even more details. Investments is an elective under the finance concentration. Now, each of these two areas, corporate finance and investments, they have some topics that kind of run across both areas. They both talk about corporate governance. They both talk about financial markets and institutions. They both use and talk about derivatives, and they both talk about the implications of being international in terms of dealing with finance across countries. Corporate governance is largely about how companies are managed in terms of the ownership and then the managers of the company. Are they the same person? Are they separate? What are the laws that govern how managers and shareholders should behave? And how are those responsibilities split up? That's all under corporate governance. Financial markets and institutions, we have a separate class in that, and that basically talks about the markets where companies and investors interact. Because companies and investors, they trade something. They actually trade money, right? A company will need to raise money so they can build a new product, and they get that money from the investment community. And those companies, the investors and the companies, they interact in what we call the markets. So kind of like, let's say, think of eBay or Amazon as a market itself, and we have buyers and sellers interacting. And so we have that as well in the financial markets. We have different financial markets like the New York Stock Exchange, or we have the NASDAQ. And these are different markets where buyers and sellers of money basically get together and they trade. And then we also have institutions. And what those institutions do, they kind of play like a middleman role where they bring buyers and sellers together. So like a company, maybe they want to raise some money to build a new product. They might employ an institution like Goldman Sachs, and that Goldman Sachs will help them go out and raise money from investors. So that's financial markets and institutions. Derivatives are an interesting area. Those are a certain type of financial security. And what's strange about derivatives is that what they are really are contracts. And they're contracts in a way similar to an insurance contract. So a derivative, the value of that derivative, like a stock option is a derivative. An insurance contract, in a way, is a derivative. The value of that derivative is based on some other event happening. So, like your insurance policy that you have, it only pays off if you get into some type of accident, right? And that's how a stock option works. A stock option is almost worthless unless something happens with the stock price. And so with derivatives, their value is derived from some other event happening outside the derivative. International. So once we cross borders with transactions, we start talking about currency. And currency trading is, it works a lot into everything we do, from how companies make decisions and the requirements companies have for valuation. It varies from country to country. And we'll see that as we go through some of the procedures for valuing companies. And then if you look at corporate finance, our class is really going to cover these first three triangles right here, or arrows. We're going to talk about goals of the company, corporate governance, financial analysis, and how to make capital investment decisions. That's this course, Finance 300. And then if you were to take the next course in corporate finance as a finance major, then you would cover these next three sections here. Okay, so in goals and governance, we're going to talk about different types of firms, because the legal structure of a company, like corporations, LLCs, partnerships, that determines the tax rate, which is important expense or money that has to be paid and has to be taken into account. It determines who controls the company in case of something like a bankruptcy. So those are very important when it comes to finance. We'll also take a look at financial markets and institutions. We'll look at the basics of how companies and investors interact and trade securities, how they trade money, how they borrow money, how they lend money. And then we'll get into financial analysis. And we're going to do a brief overview of accounting, just because we need to know accounting, because accounting is, a lot of it is the basic data that we use in finance. So you do have to be pretty knowledgeable of accounting so you can get your information and data to make financial decisions. And then we're going to spend about half the class on capital budgeting, and basically how companies decide to invest their money is basically capital budgeting. Capital is the money that companies have, and then how they budget it, how they spend that takes up a lot of the time for financial groups within companies. Financial planning, that goes into forecasting in terms of the amount of cash companies will need every month, every quarter, because very often companies might, while they're waiting for payment from a customer, they might need cash to go buy more inventory. And so the cash needs for a company can go up and down from month to month. And so sometimes companies need short-term cash loans, and so we do that in financial planning. But again, financial planning, we're not going to cover that in this class. Financing decisions in terms of where companies get their money from. Should they go public? Should they borrow money from the bank? Should they sell a bond? That's something called financing decisions. And we're not going to go into that in detail. That's going to be a next class, but at least you understand the corporate financing, how the whole topic lays out. And then the last topic in corporate finance is dividend policy. And this concerns how does a company give money back to their ownership. And so there are different ways of doing that. You can pay cash in terms of a dividend, or you can even buy back ownership from the owner, and that basically they call that a stock buyback. And you saw a lot of that over the last couple of years, and it's just an alternative to paying dividends. Okay, here are the different types of firms, and some of the biggest differences between them is how the ownership is constructed, and the liability of the company, who's liable if something bad happens, and how the taxes are paid. Those are really the biggest things in terms of the differences between these types of companies. And right now, I only have 3 here: sole proprietorships, partnerships, and corporations. But there are more, and the more options are kind of like something called an LLC, limited liability corporation, which is kind of a mixture between a partnership and a corporation. So sole proprietorships are basically sole owners, one person, they own the company, and there isn't much difference between that person and the company. If the company runs into problems, it becomes the owner's problems financially. If the company gets sued, the owner is sued. If the company is out money and the company owes a lot of money, the owner might be liable with even their house. So it's much more difficult for a sole proprietorship to protect themselves from company liabilities. A partnership is very similar to a sole proprietorship, but it has multiple owners. And then a corporation, the key difference with a corporation is there's a separation between the ownership of the companies and the management of the company. So if you invest in a corporation, basically you only be liable to how much money you put in. So if you bought $100 of stock in Apple and something bad happens to Apple, the most you could lose is $100, okay? But if you like started up your own sole proprietorship, okay, and you don't have a corporate form that protects you liability, you could conceivably lose your house, not just the amount that you invested in the business, but also your house. And sometimes sole proprietorships, if people get loans, business loans to start their companies, very often the business loan will the owner, person who's taking out the loan, will have to pledge their house or some type of asset as collateral. So if they don't make payment on the loan, the bank or the person who owns the loan can go after their house. Corporations, you don't have that. It's only the corporation itself that's liable and not the individual shareholders. So what this means then is if somebody needs to raise money for a business, you know, it can be very difficult convincing people to invest in a sole proprietorship because they could be liable for more than the amount they invest. Instead, if you had a friend who wanted to you know, start up a sole proprietorship, maybe the best way to do that would be to borrow the money, to lend the money, because then you're a lender and you're protected. And that's different from being an equity owner in the business. Same thing with transferring of ownership. If you have a sole proprietorship and you want to sell your business, that's not easy. You have to go through something called a business broker, similar to a real estate broker, but they specialize in businesses. And it could easily take a year or more to sell a business, depending on, you know, how much you're willing to discount the price. In corporations, however, it's relatively easy to raise money as long as, you know, you have a decent business, because investors aren't as worried about liability because they know they're protected by that corporate veil, if you will. Transfer of ownership is very easy in corporations. It's a matter of buying and selling shares of stock, and there are established markets that make it easy to buy and sell. The other big thing with corporations is that you do not have to be an expert to be a part owner of the company. You can buy a share of Apple stock, be a part owner, even though you have no idea how the underlying technology works for Apple. But if you're going to be buy into a sole proprietorship or a a business where you are actually an owner, you probably will have to be involved in the day-to-day business and understand the business. Some owners in sole proprietorships, they may hire a manager, but they may still have to talk to that manager once a week, once a month, to understand how the business is being run and if to help make decisions if lots of money is going to be spent. Corporations, you're never going to talk to the CEO of Apple about how the money's being spent. For taxes, it's significantly different as well. The tax rate for sole proprietorships and partnerships is basically the same as your tax rate for your income. So the income basically goes on your income tax statement. It's another form you have to fill out, and you're taxed at the same tax rate that you are with your other income. Corporations, however, they have a different tax structure. A corporation has to pay corporate taxes on their profits, but then you as an owner may have to pay taxes on the profits that are distributed from the company to you. And so, like if a company pays dividends to the owners, then the owners have to pay taxes on the dividends as well. So sometimes that's called double taxation, because corporate profits are taxed at the corporate level, but then they're also taxed on the money that they send to the shareholders at the shareholder level. So potentially taxes could be higher with a corporation than with a sole proprietorship. Here are some of the goals of the firm. And I bring this up because this goes back to economics. And in economics, a lot of it, if you recall, especially in microeconomics, from a firm standpoint, is they want to do optimizations and maximize the utility from something, right? And so when you apply economics to a company, what should a company work to optimize? What should their goal be? And so different arguments have happened over history about what the goal of a company should be. But probably the end result is that, at least in academia, in finance, it's been accepted that shareholder wealth maximization should be the main goal of a firm. And by that, I mean, when you maximize shareholder wealth, what you're really doing is maximizing the value of the company, and that includes short-term and long-term profits. Some alternative goals of the firm that might come up are profit maximization, and that's generally seen as more of a short-term focus. Let's maximize profits this year and next year. And sometimes management likes to do that, not the shareholders, but management likes to do that because it makes them look good this year, and it may maximize their pay this year as well if they're rewarded based on current performance. Some companies may choose to have social responsibility as the key goal of the firm. Some companies may choose managerial reward maximization. So maximize the income for managers. Obviously, shareholders wouldn't be happy with that, but sometimes, it's not necessarily said, but you can see in the actions of the company that they're behaving like they're trying to maximize compensation for management. But in general, this is seen as like the key thing because it maximizes the long-term value of a company, taking current and the future into account. So corporate governance, basically how companies are governed, it comes up because companies do have some structural problems in them. And you see that in that there are repeated issues with how companies behave, right? You see them in the news. And so we call these problems, we often call them agency problems. And a lot of those problems are brought out because you have a separation of the owners of the company and who manages or controls the company. So in a corporation, the ownership employs managers, which we call agents, to run the company. So the agents are employed by the managers to make all the decisions in the company. And so we call those agency problems because you now employed an agent to handle your business for you. And so the problem is, what if that agent doesn't have your best interests at heart, but instead does things to maximize their own personal gains? And so that can happen sometimes. And in a company, there are different things that are done to make sure that the management or the agents are doing things that benefit the shareholders or the owners of the company. So here are the things that are done in companies to make sure that management behaves well. One, they design compensation plans to align the interests of both managers and owners. And the way to do that is usually through the stock price, right? Because if maximizing the value of a company or the share of the value of the stock is the goal of the company, then why not link the management's compensation to the value of the stock? And so that's what a lot of compensation plans do. That's why you see a lot of CEOs get stock options, because they only want the CEO to make money when the shareholders make money. Boards of directors. So this is where the shareholders have a voice in what management does. The shareholders vote for the board of directors. It could be 5, 6, 7, 8, 9, 10, 11 people whose job it is to approve big spending by the CEO, like when they want to buy another company or have a huge project they want to spend money on. It could be approving the compensation of the CEO. So the boards of directors, their job is to directly oversee the management of the company, and if necessary, even fire the CEO if the CEO is not doing a good job. Another tool for corporate governance is audits. So this is where accounting firms like Ernst & Young and others are hired by boards of directors to audit the company's financial statements. And this is where they go through and they make sure that these financial statements are accurate. They basically look for misleading transactions, inaccurate financial statements. Sometimes companies will try to prop up their income by there are all kinds of tricks that companies have. Sometimes they can take expenses and capitalize them so they're on their balance sheet, and that makes it look like the net income is very good, because instead of taking expense for something, they put it on their balance sheet and it looks like a liability. And there are rules about when you can do that and can't. And so audits will try to pick up on things like that. We also have laws in the states and countries that companies operate in terms of how they should release information to investors and what the things that they're allowed to do. And they also, there could be a recourse, meaning that if a company does something bad or the CEO does something bad, what can shareholders do to protect themselves from the management? Those are driven by laws, and each country is different on that. Another area for helping manage companies are large shareholders. And these are more common, especially in Asia, where some of the big companies have very large family stakes or family ownership of the companies. I think of like, I think it's like Hyundai. I know Hyundai and a couple other companies. They have very large family shareholders, and that can be a form of corporate governance too, because they own so much of the company that they can go and call up the CEO and make sure that the company is being managed well. You don't see that as much in the United States, but it is seen in other countries around the world. what you see more in the United States are potential takeovers of companies. So if a company is being managed poorly and the value of the company drops because of that, other companies will be tempted to come in and try to buy up the company, fire management, and fix all the company's problems. So that's called a takeover, merger, acquisition, and it was especially became famous back in the 30, 40 years ago when companies could just come in overnight and start buying up another company's stock and then fire management. It's harder to do now, but it's still possible, and so that's called a takeover, and it is a form of corporate governance because it helps keep management on their toes because they know that if they do a bad job, other companies will try to buy them out. So what this is just kind of give you an idea of how the people in a country view companies differently. And so in the US, right, we think about there's employees and there's ownership or shareholders of company. But there's another way to think about who has a vested interest in how a company runs. You can also think about there's employees, but there's also labor unions. You can also think about the local governments where the companies act. You can also think about the citizens who live close to a company. We call them stakeholders because they have a vested interest in how the company does, right? Because if a company does well, then the government's going to collect more taxes and do well. If a company behaves properly, then the people who live around the company will probably live in a better environment. So those are called stakeholders. So there's more people who have a vested interest in how a company does than just the shareholders and the employees. So in different countries around the world, when you ask the question, whose company is it, right, you get different responses. Like from this survey in Japan, more people thought that all stakeholders kind of own the company, that labor unions, the government, local community, the shareholders, they all had an ownership in that company because they all did better when the company did better. But then if you go down here to like US and United Kingdom, you'll see here when you ask that same question, the blue, meaning shareholders, it's much more focused on it's the shareholders' company and not anybody else's. So there's just a little different mindset. So if you're operating a company or making financial decisions in different countries, it's just something to think about, that it's not that easy to do something like, say, have an employee layoff or something. In some countries, that can be very difficult to do. Let me give you an example. In Germany, the local government and the labor unions automatically, by law, have a certain number of seats on the board of directors. So when a big decision is being made, the labor unions and the government have to essentially approve those decisions by those companies. When you go to France, I worked on a company we were looking at buying a company in Europe. And the thing with the French companies that I remember being talked about is that it's not that easy to restructure a company because of all the employment laws and the difficulty in making changes. And I'm not trying to say anything bad about France. It's a great country. It's more that you have to look at the detailed specifics about how companies operate in each country. And you can't just assume that, oh, we can go into France and we can do X, Y, and Z. It's not that easy. You can't always go into a country where you do not normally operate and assume you can go and make any changes that you want. So that's the only point of this, that other stakeholders in companies outside of the US, they often have more say about what happens within that company. Here's an example of that. In this survey, people were in companies, they were asked what's more important, shareholder dividends or employee jobs. So if the company's losing money, what's going to happen? Is the company going to stop paying dividends, or are they going to lay off employees? And you can see in places like Japan, Germany, and France, it's much more favored toward maintaining employee jobs. It's a little different here in the United States. It's more about maintaining dividends. And I'm not trying to be critical or negative, but it's just kind of, you know, the environments are different. If anything, maybe Japan and Germany and Europe, they're becoming a little bit more like United States, but it's still different. Like during the last financial crisis, not the COVID right now, but in 2008, 2009, I believe in Germany, companies were actually given payments to keep on their employees during 2008, 2009 and not lay them off. So they received government payouts to make sure that they didn't lay people off. So who knows, maybe US is changing, because I think some companies may have received some financing, right, during the COVID situation to make sure they didn't lay people off, but it is a little bit different depending on where you go. And so, you know, think about this. If you're an investor and you own stock, right, and there's a major recession, where are your profits or your dividends going to go first? You're probably going to lose them in Japan, Germany, and France, but they might have a better chance of being maintained in United States and United Kingdom. I don't mean this from a negative standpoint, but with every investment, you have to remember, we have to forecast how much cash flow we'll get in the future. And sometimes you have to think about what's going to happen in a recession. So that goes into pricing, you know, the valuation of securities and the decisions that we make. So I see a chat here, PPP. Can someone translate that for me? Is that a question?
Oh no, I was just saying the Paycheck Protection Program, when you're talking about the money that the.
Oh yeah, yeah, that's right. Yeah, so maybe the U.S. is changing too. So they're meeting more in the middle. So this is about the different types of assets. And in finance, we have two different types of assets. There's real assets, things that you can touch, things that you can use to produce goods and services, things that companies invest in, things that companies buy to make things or sell services. Those are real assets. Then you have financial assets. And financial assets, they're ways of raising money. So you can sell a financial asset. You can sell a share of stock, an equity ownership in the business, and then get money for that in return. You can take out a bank loan. That bank loan becomes a financial asset for the bank because now they know you owe them money. You can sell a bond. A company can sell a bond to investors, which is basically like a loan. So financial assets are based on raising money, things that the company does to raise money so they can invest in real assets that actually make the profits for the company. And so when a company decides on which real assets to buy, we call that the investment or capital budgeting decision, because they have to decide how to budget the money they have to buy real assets. And then where they get their money from, that's called the financing decision. Do they take out a loan? Do they sell shares of stock? And so so that's pretty simple, I think. If anybody has any questions, we'll go into some of these financial assets in more detail when we talk about financial markets, because that's where those financial assets are traded, they're bought, they're sold.